Hey traders, Jason from Levitt Brothers. So in this video, I'm going to lay out a few reasons to be optimistic about the future. Maybe not in the very near term or intermediate term, but when you look out a year from now, there's a lot of stats that point towards the likelihood of the market posting a pretty good gain. Now, there are a lot of smart and experienced people who would argue for this. They'd argue that the market is pounding out a bottom right now and that we're pretty close to being done with this bear market. There's also a lot of smart and experienced people who say, no way, we're, at the very least, we're going to leg down one more time, the S&P low 3000s. Okay, so you can pick a side if you want, or you can just trade whatever's unfolding in front of you. In this video, I'm going to point out a mostly bullish case. Okay, so if you want to be optimistic, here are some of your arguments. Okay, so number one, the market, it's well documented that the market it always suffers some sort of sizable pullback during midterm election years. But the rally off of that low, or off of midterms, is pretty sizable. So in this image shown, this shows the S&P returns after midterms. Okay, so it actually pinpoints the exact day that midterms happened. Since there's 1950, you can see 16.2% return off of that midterm, and it goes on. We don't have to go through all the numbers. You can see every single one of these is blue. So 1 year after midterms, there has always been a rally. Even in here, 86, 87, which included the Black Monday, where the market fell more than 20% in one day. Even that 12-month period ended with a gain. Okay, so the average was 15.1%, and for all other years it's 7.1%. So 7.1%. So the average gain off the midterm after midterms was double what it normally is. So that's this is 100% of the cases we rally off of a midterm low. Now I have to point out here that this is the .com, so we did actually get a rally off of the midterm off of midterms in 2002. But in here, the financial crisis was in 2008. 2008 was not a midterm year. Okay, so there are some data points that aren't included in here because it wasn't a midterm year. But anyways, there you go. Pretty good 100% tendency to rally off of the midterm. All right, now why? Now we're going to take a different approach to this. I realize this is hard to read. This is from Ryan Dietrich. He says why instead of using the midterm, actual election day, as your measuring point, why not just let's measure off the midterm low? Okay, so here's 1950 over here. Here's 2022. Okay, so those are all your years. This column is the date that the low was put in place. Okay, this next column is the midterm year pullback. Okay, you can see in 1950 we dropped 14%, in 1954 we dropped 4.4%, and in 2022 we dropped over 25%. So every single year we've had a pretty sizable drop, with the average being 17.1%. And then cherry picking the exact low of the midterm drawdown, these are the gains 12 months later, and you can see it's all green. The average is over 32%. There's only one number in there right there that's less than 10%. There's another number there that's 11%. Otherwise, most of these numbers are above 20. Many are above 30. A couple above 40. There's one above 50, which is almost 60%. Okay, so if you cherry pick the midterm year low, 12 months later, you have not only 100%. Not only do you have a gain 100% of the time, but you have huge gains, which tells you that. Now, obviously, I'm pinpointing the exact low. You don't know when the low is, but even if you miss the first 10 or 15%, there's still going to be a lot more upside to go. And just like the last one, I'll point out that the financial crisis would have been right in there. That was not a midterm low. It was not a midterm year. So not all periods are here. It's only the midterm years. Next up, this is from NDR. So the blue line it's a combination, it's a composite of the 1 year seasonality cycle the 4-year presidential cycle and the 10-year decennial cycle, okay? Equally weighted, and then it maps out what a typical year is. And what you see here is like we're mapping it pretty good. And then the orange line is what we're doing right now. Okay, this was updated at the end of September. So if I could fill this in, we actually did drop. We moved up. We actually dropped to a new low, and then we moved up from there in November, and now we've dropped back a little bit. Okay, so we're actually mapping this pretty well. This just tells you when you map all those, when you take a composite of all those different cycles, we're actually on pace, and there tends to be a rally here. Obviously, there's going to be outlier years, but if this matches the average of history that goes back almost 100 years, we should be in good shape for a year-end rally. Something to be optimistic about over the next couple months. All right, this next chart, also from NDR, there's 5 lines here. This dotted line is all years, all election years, and the 5 other lines are basically the blue one is like Democrats. Like what happens during a midterm year when a Democrat is a first-term president. The red line is a Republican first term. Then this kind of off blue one is a Democrat second term, and then the orange one is a Republican second term during midterm election years. Okay, we want to map like what typically happens during a midterm election year as a function of whether there's a Democrat or Republican in office and whether it's their first term or second term. So without getting into the more detail than that, right now we have a Democrat, a first term Democrat, so that's the blue line here. And what we show here is we show a bottom in late October, early November, and a tendency to move up for the rest of the year. Okay, something for the bulls to lean on. All right, so here are some numbers. Looks confusing at first, so I'll map it out. So I'm going to make a couple of comments. Number one is like the best way to operate is to have a longer term uptrend and then have a shorter term pullback within the uptrend. And when you buy and buying that pullback gives you good risk reward. Okay, long term uptrend, then a shorter term pullback within that uptrend. When this happens at a certain time of the presidential cycle, it turns out to be very bullish. So the most bullish time of the presidential cycle is the last quarter of midterm year, and then the next couple quarters after that. Okay, so in this case, when the 200 week, I don't know if I'll be able to write this, when the 200 week is trending up and the 40 week is trending down at the exact same time we enter this bullish time of year, the best part of the presidential cycle, we have pretty good results going forward. Not just pretty good, but like really good. Okay, in fact, it's happened 7 times. Okay, 7 times we've entered, 7 times we've been October 1st of a midterm election year, and the 200 was rising and the 40 was falling. When that has happened, it's happened 7 times, and the results have always been pretty good. So when you consider that, when you look at Q4 and then Q1 of the following year, we're up 100% of the time with an average gain of 16%. When you look at Q4 plus the next 2 quarters of the following year, you're also up 100% with the average gain being 20%. And when you look at Q4 plus the next 3 quarters of the following year, okay, so 12 months total, you are also up 100% with 23% average gain. Okay, so when you have a dip, a short-term dip within a long-term uptrend, exactly when we enter the strongest part of the presidential cycle, the market tends to do very well looking out 6 months, 9 months, 12 months. Okay, it's another thing for the bulls to lean on. All right, so here's a chart which offers not a warning, okay, but it's something. So what this is, and this is from Seth Golden I got grabbed off to Twitter. When the S&P 500 is above its 200-day moving average for 143 days, what tends to happen looking out 1 month, 3 months, 6 months, 12 months. So looking at this last column here is 12 months. You have a lot of big gains here. Look, this is like 33%, 34%, 30%, 17%. There's a lot of big numbers here. There's two big outliers. Right here we have a minus 25%, which was during the financial crisis, and you had a minus 12%, which was during the dot-com bubble. So it seems like when the market is below its 200-day moving average for an extended period of time, that the market, when you look out 12 months, the market tends to rebound, okay? Except if there's something drastically wrong with with the situation, and in that case, you don't get a bounce. So that's something to look at. You can ask yourself whether the current situation is normal or whether it's something much worse. Now, something else I want to point out here is 1974, which is a time that is often compared to the current situation because of the inflation back in the 70s. When the S&P was below its 200-day moving average for 143 days, a month out, it was basically flat. 3 months out, it was down 19%. So there was a huge drop between the 1 month and 3 month time period. 3 months after that, the drop was 23%. Okay, so between 3 months and 6 months, it dropped down a little bit more. This kind of tells me that, market probably dropped hard, bounced, and then 3 months later, you probably had, a marginally lower low. But then 6 months after that, you had a complete recovery back to break even. So it just tells you that during the inflation of the 70s, you had a huge drop, but then a recovery. So it's something to think about. Okay. It's something to think about that when the market is down below its 200-day moving average for this many days in a row, it tends to bounce back unless there's something drastically wrong. In the case of 1974, there was a huge drop and then a recovery. And in the case of the dot-com bubble and financial crisis, you just had a lot more losses. All right, so to sum it up, there's a tendency to bounce big after midterm elections. Okay, there's a tendency to bounce even bigger after the midterm year low, but there were some big losses a year later during the dot-com bubble and during the financial crisis, and there was a big drop in 1974 before a recovery took place 12 months later. I just went over that, which brings me to a statement I've made or asked dozens of times over the last couple months. Is this a normal rank and file bear market? If this is a normal rank and file bear market, the market will probably be fine just a year from now. Okay, but if it's something much worse, then all these stats can be thrown out. And, a lot of times you look at a stat and it's like, hey, this XYZ has happened. And, over the last, 35 occurrences, like 34 to the 35, the market did this. Well, if this is much worse than a normal rank and file bear market, then we're going to get some of those exceptions. Some of these stats that have printed 100% of the time over the last 50, 60, 100 years, we're going to get that one time that it doesn't print. All right, so something to chew on. Bulls can be optimistic, okay? If they actually think this is a normal bear market and we're going to figure things out and we'll be fine a year from now, there's really high odds that the market's going to not just be up a year from now, but up big. But if there's stuff going on that's much worse than a normal bear market, all bets are off. The market is probably going to go down much, much more.